This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Stocks set to drift as markets await the Fed decision, with traders split on the size of an interest rate cut and the likely impact on risk appetite. Also ahead, Steve Cohen stepping away from the trading floor at 0.72, marking the end of an era for a dominant force in the hedge fund industry.
And we're live in Singapore for the Token 2049 Global Conference, talking about the future of crypto with guests including Animoca Chairman Yat Su and Dragonfly partner Rob Hadick.
But of course, the focus right now is that countdown to the Federal Reserve. Haidi, of course, we're still seeing that debate between a 25 basis point or a 50 basis point cut. Jeffrey Gundlach now has his call that it could be a 50 basis point rate cut. But at the same time, of course, we have seen those record wagers when it comes to the markets of what size the Fed could go, and that really risking a lot of volatility in the markets. Jamie Dimon saying that whether it's a 25 or 50 basis point cut, it won't really be that impactful. Take a listen.
It matters to me because I have to listen to all that people yapping on TV all the time about something that's almost irrelevant. I mean, they're going to do it, 25, 50 basis points. It's not going to be earth-shattering. It doesn't mean that much. I mean, I think they need to do it. So I'm not, I think Jay Powell does do a great job, but it's a minor thing.
The question, of course, is going to be whether the market reaction will be earth-shattering, right, given how divided expectations have been on both the scale of what the Fed will do and the scale of how investors will react. Perhaps further complicating matters is, of course, looking ahead to US retail sales numbers. The surprise gain, of course, was really helped by online stores. We had sort of the value of purchases rising just by 0.1% in August. The estimate was a 0.2% drop. We had control group sales increasing for a fourth straight month. So that was quite unexpected. Mixed results at some of those other merchants as well. So unadjusted for inflation, we saw that slight increase in the value of retail purchases, according to that Commerce Department data. That's stripping out, though, sales of cars and gasoline stations. That shows an advance for the fourth straight month. So this really kind of, the takeaway, Shery, I suppose, is pretty resilient household demand. That's halfway through about the third quarter, even as we see hiring, we see wage growth showing signs of some moderating. So it really doesn't settle the debate as to how quickly and how big a move we should expect from the Fed.
Which is why policymakers are conflicted, which is why investors are also confused, right? When it came to those retail sales numbers, we did see U.S. stocks getting a little bit of a boost in the overnight session, but still really unchanged, hovering very close to that really record territory. We're talking about surpassing that level after that data came out. But take a look right now, because we're really not doing much in the Asian session. U.S. futures not moving much. A lot to do, of course, with how we're trying to interpret data and where the Fed is going from here. So that Treasury rally also took a breather overnight. We actually had yields rising slightly, and with that, a boost to the U.S. dollar from the lowest levels since January. On the other side of that trade, take a look at how the Japanese yen is doing and how Asia is setting up, because we actually saw the yen leading the losses overnight among the G10 currencies. Right now, we're still strengthening a little bit towards that 142 level. And this coming at a time when we had the Nikkei really falling for two consecutive sessions already. Right now, futures pointing to a slight upside, Haidi.
Shery, one of the stories that we'll be watching when it comes to the Tokyo session is the situation when it comes to Nippon Steel. Nippon Steel said to have won an extension for the review of this deal, this $14.1 billion deal for United States Steel Corp. This likely then pushes the decision on the politically contentious takeover past the U.S. elections in November. So that's really interesting when it comes to timing. That would restart the clock on the security review to buy the U.S. steel asset. We know that President Biden, Vice President and presidential candidate Kamala Harris and Donald Trump all say that they oppose the acquisition, I should say. So the move technically would allow the company to revoke and refile its submission to the security review panel, kickstarts the clock again. That would keep the proposed transaction alive, even as we've seen all this political opposition as well. The president, of course, has given no indication that, he is really moving when it comes to his opposition on the proposed purchase. This is according to people who spoke to Bloomberg on the condition of anonymity to discuss the details of this review. And of course, this has been such an election flashpoint, right, particularly in that key swing state of Pennsylvania, where the union has opposed the sale, and that's where it's based as well. So we continue to watch this as we hear that Nippon Steel has apparently won an extension for the review of this takeover deal. And let's get back to the Fed, because Bloomberg opinion columnist John Authers says whether the Fed delivers a 25 or a 50 basis point cut, it will still be the biggest surprise since the global financial crisis. He joins us now from New York. And John, you know, with all the posturing in these markets, expectations are shifting, expectations that you continue to see, it kind of, you know, is both surprising but also makes sense that there are still surprises left in this outcome.
Well, yeah, I wouldn't want to place any money at all either way between 25 and 50 at this point. It is the worst that expectations have been allowed to hang out in the middle, that we really have had a 50-50 shot in the eyes of the market coming in on the eve of a decision that's by far the biggest uncertainty that we've had since at least the global financial crisis. The Fed has been very anxious to lead the market by the nose and make sure that you don't get that kind of uncertainty. I do actually tend to agree with what Jamie Dimon was saying earlier, however. I don't think after a lot of very exciting trading in the next few hours, whether they go by 25 or 50 matters a particular amount in the greater scheme of things. We have a lot more to learn. And at this point, you can analyze the data all you like. But it's ultimately about the judgment of those few people in a boardroom in Washington. If you're worried about the level of rates, then no, they don't need to be as high as they are with inflation coming down. If you're worried about the rate of change of rates, the economy is looking way strong enough to not need a really big cut. It basically comes down to whether you look at it as a level or as a rate of change.
How closely, John, do you think the Fed is watching just external conditions, not just financial markets, the broader level of equities and bonds, but just the volatility that we have seen with the yen carry trade unwind, for example, the last time after the BOJ hiked rates?
I think the yen carry trade is certainly the single biggest issue that they should be looking at. Obviously, the extent of the unwind at the beginning of last month actually had quite serious people saying that the Fed should cut by 50 basis points immediately between meetings. Really would have been a sign of panic. There's any number of different versions of exactly how much money is still tied to a cheap yen. But well, we wrote a report yesterday about the latest research from the Bank of International Settlements. Certainly suggests that there is more carry trade to be unwound still, and that would counsel against doing something that would make the yen rise very sharply, i.e. that would be a reason to cut by only 25 basis points. If you're talking about other markets, the stock market, the US stock market is virtually at an all-time high. There is no good reason to cut rates to save the stock market. It doesn't need saving.
John, as you say, you know, the practice or the hobby of second-guessing the Fed and the chair is you know, a key skill for traders, right? But this has been a really unusual level of speculation. Does this tell us that this is what we're going to get for the rest of the easing cycle?
No, not necessarily. I think at the moment you have an unusually ambiguous situation where the data isn't really telling you clearly what to expect. And you also have the problem, we do have the other thing we can't avoid mentioning much, though we might prefer not to think about it. We do have an election coming in the US in November, and the potential shifts in fiscal policy and trade policy that could come with that might change things very dramatically. I certainly think that if Donald Trump does get in and do what he says he's going to do, that will mean that interest rates aren't going to come down anything like as much as people currently predict. So that there are those big uncertainties still immediately ahead of us, but we should have a fairly clear idea, you would hope, before too much longer, where we're heading, and the Fed should be able to get a better control of the messaging as time goes by. My personal suspicion is that rates are not going to come down. Whether or not we get Trump 2.0 here in the States, rates are not going to come down as much as the market thinks they are at present, because I don't think the economy is in as much trouble as people think it is at present.
John Authers, good to have you with us, Bloomberg opinion columnist, with his take on where we go here in the markets and what we're expecting from the Fed as well. Now, Iran-backed Hezbollah is blaming Israel for an attack in Lebanon that killed several people and left thousands wounded. A string of medical emergencies were reported across the country following the mysterious explosion of thousands of pagers. Let's bring in Bloomberg cybersecurity reporter Jamie Tarabay. Jamie, so there's a lot of finger-pointing going on right now, but what do we know at this point?
Right, as you said, there is a lot of speculation about who is behind it. We don't have confirmation from the Israelis themselves, although everyone is really pointing the finger in their direction. It comes, this very audacious attack comes a day after Israel had said that it was planning to take some kind of action against Hezbollah to free up the territory close to the northern border it shares with Lebanon, so the people who had left the northern part of Israel and evacuated because of all of the rocket attacks Hezbollah had been sending down to Israel would be able to come back. They'd evacuated because of the danger there. There is a lot of speculation. Clearly, Hezbollah and the Lebanese government have blamed Israel. Hezbollah has vowed to retaliate. But right now, there's a lot of chatter and not very much has been confirmed.
But on your last point, if this has, does turn out to be confirmed, to be carried out by Israel, as is the speculation, what are the risks that we're seeing in terms of the sort of reprisal? Because by and large, a sort of a tit for tat across the region has been relatively managed.
Yeah, I think tit for tat is a really good way of describing it. We've seen these repeated audacious attacks reportedly carried out by Israel, an assassination inside Iran of a Hamas leader, an assassination inside Beirut of a Hezbollah leader, and the retaliation, for want of a better description, has not been as severe as Hezbollah has vowed, and so has Iran. And, there is obviously the fear that there is something that could ignite both Iran and Lebanon, and obviously in Gaza and Hamas, so Israel on so many fronts would have to fight. And the U.S., the White House, are really doing their best to try to calm tensions, to pull people back from that kind of escalation. Right now, though, I think that in the short term, I don't know that we will see anything beyond those rocket attacks from Hezbollah into the northern part of Israel.
Jamie, we know for a fact that Israeli intelligence is very competent, but they never necessarily acknowledge some of the sabotage that they carry out. What do we know at this point about really using these antiquated pagers to carry out attacks?
It's a very smart way to communicate for militant groups, for anyone who doesn't want to have their communications intercepted. I will, however, say that hospital staff use them because of whatever, they like this kind of low-tech messaging. They also don't get interrupted during their medical work. But for people who do use it for nefarious reasons, you can really kind of communicate with other people who have these pages in a really low-tech way without revealing locations, without pinging on a satellite so someone can track your location. As you said, the Israelis are extraordinarily gifted in this area, and their surveillance, their tech is next level. And whatever most, you'll find that Hamas is doing this as well in the Gaza Strip, have really rolled back on using modern day technology, or at least technology in this decade, to try to keep themselves literally under the radar and not to attract positioning and anything that can give Israel any sort of intelligence on their whereabouts, their movements, and their communications.
Bloomberg cybersecurity reporter Jamie Tarabay there with the latest. Coming up on the Asia Trade, we're live at this year's Milk and Asia Summit in Singapore. Cain International CEO Jonathan Goldstein joins us to talk investment opportunities in the commercial real estate space. Plus, Dalio sharing his views on the US presidential race and the strength of the world's major economies. This is Bloomberg.
You're watching the Asia Trade. We head to Singapore, where the 11th annual Milk and Asia Summit is underway, gathering more than 1,200 global leaders in business, finance, tech, and philanthropy. Our colleague Hazinda Amin is there with a special guest. Haz.
Well, Shery, the world is more profound than it was more than 10 years ago. Lots of issues being mulled over, including the state of the economy. Of course, the Fed, higher for longer. And you know what? When it comes to higher for longer, it's impacted the commercial real estate. Perhaps better days are ahead. Let's get perspective. Jonathan Goldstein, CEO of Cain International, is with me this morning. Good to have you with us and welcome to my city.
Good morning. It's wonderful to be here.
So we know the commercial real estate has been under a lot of pressure. Lots of questions on whether it has bottomed or not. Given the trajectory of, interest rates trending lower, that must be good news to your ears.
No, I think you're absolutely right. I mean, it's felt in the real estate industry that we've been in a boxing match. First of all, we had the left hook of the pandemic. And the higher, the strong impact and the fallout from the pandemic. And then we had the right hook of inflation following the Ukraine war and otherwise. So we're beginning to see signs of growth and signs of good fortune coming in the industry. And obviously a rate cut today in America would be a big boost to the industry. It would both enable people with existing assets to refinance at lower costs and also enable people who are looking to invest, to start new projects, which every economy needs, every industry needs, to start looking at investing more capital. But may I say that in addition to the Fed, I think the biggest fillip to the industry that I've seen in some time was Amazon's decision this week to tell people from January to go back to their offices 5 days a week. Because the real estate industry needs this, but I would also argue this is good for young people. I think I've never believed that the working from home culture was good for young people's mental health or their career progressions. So we're hopefully seeing some real positive dynamics out of that as well.
Before we get to office space, to do with the Fed and rates, for you, it doesn't matter whether it's 25 or 50. It is the trajectory, the rate cuts expected in the coming months.
I think that's right. I think it's really important that we begin to take a breath and say, okay, we've come to the end of this cycle of higher interest rates, that the Fed is on a journey to bring interest rates back to some level of average normality. And so I'm less obsessed as to whether it's 25 or 50 basis points. Obviously, 50 basis points would be more welcome. But I think it's much more important to hear the comments and the messages from the Fed and seeing its direction rather than the actual number.
But what kind of a boost, what kind of recovery can be expected? Can you put that in perspective for us? Well, if you can put some numbers, it's even better.
Well, numbers, of course, your borrowing costs go down by, some considerable percentage points.
What does that mean? What does that mean for the business?
Over time, if you're borrowing at 5% plus a heavier margin, your borrowing costs on average have been between 9 and 10%. If that starts to trail back to somewhere between 6 and 8% over a period of time, that's a big, big margin for developers when they're looking to invest and real estate owners when they're looking to invest in their properties. So I think it is really important that you can't really say that one rate cut is going to mark such a sea change in an environment. It's not like yesterday was terrible and tomorrow is going to be great. But it is important because industries are about conviction and confidence. And when people start to feel confidence in the trajectory, in the journey, then people will invest their capital.
So there must be conviction now. After all, the market's pricing 100 basis points by the end of this year.
But then don't forget, during the course of 2023, there was a lot of excitement that so many rate cuts were coming, and then suddenly that air came out of the industry, that air came out of the environment. It didn't happen. So it is important to actually see it happen. And the actual happening is a big event because of that, because it's not just talk, it's action. And we all prefer action over talk.
What are you doing in terms of investments? What's your credit strategy? What's looking attractive?
Well, so I think we need to look at my business in two ways. We both have a debt business. We've lent over $12 billion over the course, and we've really focused on those areas that we feel comfortable with in the luxury world, in student housing, in residential, in certain key areas. On the investment side, we've really very heavily focused on the luxury space, and we've also very heavily focused on Florida. If I can just take those two things separately, we have seen a very, very large investment in the luxury world since the pandemic even. People want more experiences, they want more enjoyment in their lives, and we've had an environment where the rich have had more disposable income to use for that purpose. So we invested in the Aman Hotel Group, and together we are developing the largest piece of real estate in the west coast of America in Beverly Hills, building a new Aman Hotel, almost 200 residential, revamping the Beverly Hilton. So it really is a very, very exciting project and where we're spending a lot of our time.
Jonathan, I'll be remiss not to ask you a question on Chelsea, because you're a Chelsea director. After 2.5 years, that redevelopment of that stadium is still in question. What's happening? What can be expected?
Look, the development of a stadium within the centre of London is a very, very complicated project. And it's something that we've worked extremely hard on since we became involved with the club. In the course of the last year, we hired Jason Gannon from SoFi in LA, who helped build that amazing stadium just outside Los Angeles. He is now the Chief Operating Officer of the business, and he's been working very hard so that hopefully in the short term we'll be able to come back to our supporter base, explain to them what the future looks like and how exciting that future will be for Chelsea.
So we could see a new stadium by...
Well, I hate putting dates on things because this will get played back to me over many years. But you can be assured that the ownership group is really very focused on making sure that Chelsea has a winning environment, both in the men and the women's teams, to ensure that we can add to the studied history of Chelsea and add many, many more trophies over the coming years.
All right, Jonathan, we have to leave it there. Jonathan Goldstein, Cain International. We're coming to you live from the Milk in Asia Summit. And, of course, we'll be here throughout the morning. Keep with us, stay with us for all the conversations. Shery, Haidi.
Our Chief International Correspondent for Southeast Asia has Linda Armin there in Singapore. More ahead on the Asia trade. This is Bloomberg.
This is the Asia Trade. Here are some of the stories that we're following this hour. Donald Trump saying that he will revive a state and local tax deduction that he capped during his first term if his re-elected U.S. president. Capping the so-called SALT deduction had a disproportionate impact on regions with higher taxes and property values, typically dominated by Democrats. The announcement came ahead of a rally in New York where Kamala Harris is leading polls. The Democratic presidential nominee, meanwhile, says she wants to cap child care costs for working families at 7% of their income. It's the first time Harris has publicly spoken about the initiative in her campaign. We'll have more on the Asia trade. This is Bloomberg.
All right, take a look at how we're tracking when it comes to trading in FX. Ahead of the Fed, the expectations continue to be jostled around. We saw the dollar gaining somewhat after the retail sales numbers really edging higher for the first time in that session out of 5. Those retail sales numbers for August unexpectedly saw a small rise, but still bond traders are still favouring a half-point cut from the Federal Reserve. The yen, after that 5-day rally, leading group of 10 losses against the dollar, so taking a little bit of a pause. We're also watching expectations when it comes to the impact on the Chinese yuan as well. We've seen that decline against the greenback this month, also down against all Asian peers. So really on the issue of economic fundamentals, expectations are that we will see further weakening there. Let's bring our senior reporter for FX and rates reporter Ruth Carson, who joins us now. So, Ruth, you talk about the dollar action today and the retail sales numbers. How do we see it trading as we get into the Fed decision and, potentially reacting depending on which outcome there is?
Well, in a word, it's going to be a choppy 12 to 24 hours ahead as markets digest everything from not just the decision itself and the size of the pending cut, but also the dot plot and what Jerome Powell would indicate to markets. Now, if we take a step back for a moment and look at what the dollar has done, it actually rose yesterday for the first time, in 5 sessions. And it just sort of shows how jittery people are when it comes to trading the dollar. We know that a lot of the weakness is baked in because of the expectation that the Fed will have to cut in a series. But the question is it overdone? And now, depending on where you sit on the fence, sell side, buy side, there's plenty of recommendations and big trades going around on the big dollar. But in a word, absolutely, it's going to be choppy. So hold on to your seats.
It's been really choppy already for the Japanese yen. So what are some of the currencies that are expected to benefit the most against the dollar?
Absolutely, and definitely in this part of the world, the yen is so much in focus. Now, don't forget, it was just 2 months ago that we saw the yen trading at about 161.95 against the dollar, and we are at about 142 today. Now, that's a huge move, and a lot of it comes down to the rate differential story that we have talked about, written about endlessly, because it's the main thing in focus in terms of whether it will continue gaining against the dollar and what's likely to be the biggest beneficiaries here. Absolutely, the yen. Macquarie, for instance, is seeing dollar yen at 135 by year end. Now, also, if you look at the other side of the world, 0.72 is arguing that there is plenty of room for the euro and the Brazilian real to gain against the greenback. The ECB, for instance, expected to cut at a much slower pace compared to the Fed. And then in Brazil, you're expecting policymakers to even potentially hike rates. So going to be very interesting going forward. But a lot of people are expecting major currencies to gain versus the US currency.
Yeah, we'll be watching the fireworks in the next few hours. Senior reporter for FX and rates, Ruth Carson there with the latest on the currency space. But take a look at how we're setting up for the equity markets open across Asia. Of course, we do still have South Korea and Hong Kong away on holidays, but Sydney futures pointing to the downside of about 0.5%. But remember, this is a market that's gained already for the past 4 sessions. Nikkei futures pointing to upside right now. We had seen Nikkei losses for the last 2 sessions, and we have a lot of volatility on the Japanese yen. Right now, we're seeing it, as mentioned, a little bit of strength against the dollar, but of course, we had seen some weakness in the overnight session. Now, Bloomberg has learned that Nippon Steel will receive an extension in the security review of its $14 billion bid for U.S. Steel that's likely to push a decision on the politically contentious takeover past the U.S. presidential election in November. Our breaking news editor Gareth Allen joins us now for more on this. And of course, there was the CFIUS review that was coming up. I mean, was this sort of expected, just push that issue down the road?
Yeah, that's very right. I mean, the deadline was the 23rd, next Monday. And we were hearing for a while that it's likely to be pushed back, and we've had people familiar speaking this morning that have confirmed that it's likely that the deal is going to get a 90-day extension. That means that Nippon Steel's proposal is going to be withdrawn for a moment, and then they'll refile it, and then they get another 90 days to do it, which will push it right back past the election, which means that some of the political implications are going to be pulled back in terms of their deal.
It seems so fundamentally, though, you've basically got every potential presidential outcome still opposed to this deal, on the basis of the proposed acquisition. So is this likely to kind of just kick the can down the road, and the outcome doesn't seem like it would be particularly different from a political standpoint?
Yeah, I mean, that's exactly right. I mean, Biden, Harris, Trump, they all don't want the deal. They've all said quite clearly that they want to stop it. So it is a kicking the can down the road sort of a thing. But I mean, if you think back to what the company has said, I mean, what US Steel has said. I mean, US Steel has said that if their steel doesn't go forward, then they're going to have to fire people. They're going to have to close plants. Both of the companies have said that this is, it is a good deal. So, the political situation here is incredibly important, but the fundamental background of the deal is also very important, and we need to look at that. We'll be watching the shares of Nippon Steel as the market opens at 9 a.m. this morning, see what the market makes of the latest update on this.
Our breaking news editor, Gareth Allen, there with the latest on that US Steel deal. Well, BlackRock and Microsoft are teaming up to invest in data centres and other infrastructure supporting AI. This strategy aims to attract $30 billion of private equity capital. Let's bring out Bloomberg Intelligence senior analyst Mandeep Singh for more on this. Mandeep, this collaboration comes at a time where there's a lot of investor impatience over when we're going to see returns and efficiencies from AI, right? What do we know about this venture and what they're hoping to get out of it?
I mean, look, Microsoft was one of the earliest companies when it comes to betting on generative AI with their OpenAI investment. And right now, they are clearly seeing the laws of scaling playing out in that generative AI model training and inferencing. And everyone has realized that these AI workloads don't run very well on traditional data centers. So they are thinking, 3, 5, 10 years ahead. Where can we run these massive AI workloads? And I think data center investments take time in terms of, actually building the data center. You need the power infrastructure that goes with it. And I think having BlackRock or somebody who specializes in real estate like Brookfield Asset Management, I think they are also launching a new fund. So, this is a long duration sort of investment, and all signs are pointing to Gen AI being a secular cycle that is showing no signs of digestion.
The investments will be mostly done in the United States. Is that also the forecast that we are going to see most usage in North America, and what would that mean for the power grid across the United States?
Yeah, look, no matter where you are globally, currently, if you put an AI data center on a power grid, it won't be enough to, supply the power to the data center, or it's going to impact, the other places that are powered by that grid. So clearly, there is a need to upgrade that infrastructure as well, the electricity and the power. And that applies globally. We don't know the details how that $30 billion would be split up, but my guess is, a company like Microsoft that operates globally is going to invest globally, and that's why they have partnered with the likes of BlackRock. And I wouldn't be surprised if there are other partners in that fund as well.
Bloomberg Intelligence senior analyst Mandeep Singh there with the latest on that AI investment. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how cryptocurrencies are trading at the moment. We are seeing Bitcoin rising and holding above that 60,000 level after the best day in more than a month. Remember, it was a risk-on session on bets that the Fed will start aggressively easing. Bitcoin has been trading within a fairly narrow range for a while already, but smaller cryptocurrencies also led those gains. We are seeing a little bit of downside pressure for Solana and Ether in the Asian session. We saw a little bit more optimism over the cryptocurrency space with MicroStrategy announcing that they will be selling convertible notes in order to purchase more Bitcoin. That's really added to the optimism in this space, Haidi.
Well, Shery, the Token 2049 conference begins in Singapore today, featuring leading global voices, decision makers across the crypto industry. Let's get over to the event where our tech reporter, Annabelle Jewellers, is standing by with her next guest. Belle.
Thanks, Heidi. Yeah, well, there's certainly a lot of optimism for this event taking place today. And I'm joined this morning by the Animoca brand's co-founder and chairman, Yat Su. And Yat, it's been quite an interesting year for crypto. I mean, we came into 2024 with so much optimism around these ETFs that were starting, spot crypto ETFs. We had the anticipation around regulation, but Bitcoin and other tokens have sort of really largely traded down and perhaps sideways as well. So what's your take on the environment today?
Well, first of all, we broadly still think the market is very good if you consider what happened exactly 1 year ago. And you look at, for instance, the market overall, it's increased. But I think what's also happened is there's been a lot more projects coming out, right? So these days you have to look at projects that have institutional backing and support. So when you take a look at what happened to tokens like, Mocha or Solana or Ton, the fact that they had institutional backing helped them basically stand out from the rest of the crowd. And that's just what you see with Bitcoin ETFs as well. Bitcoin also recently saw some new inflows. But remember, in the US equity market, 80% is institutional. But actually in the sort of, crypto markets, actually, it's more like the opposite, right? It's more like 80-90% of it is basically not institutional. Institutions are just beginning to look at the space. And that's something that will take time. And of course, the market itself is also macro denominated as well. I mean, the number of people that are going into Web3 is also increasing. So you can't just look at the prices. You also have to look at the number of people, particularly in Web3 gaming. If you look at, for instance, Telegram opening up essentially with Ton, you can now see, with our own platforms like Gaming, we have 95 million registered users, 3 million daily active users. Those were numbers that would be even impressive in Web 2 world. That's actually now all happening in Web 3.
What do you think then is going to be sort of the big driver for crypto prices from here? Because Shery was just saying that we're sort of seeing that trading anticipation around Fed rate cuts. There's also the US political outlook. What do you see as the next big leg, I guess, of the move?
Well, I mean, I think the sort of political scene definitely will have an impact in terms of, because of whether it's more, let's call it, positive in the regulatory side in crypto, particularly, the US is, of course, one major market that people are looking at, but the rest of the world is still moving on. Like, for instance, what you see in Hong Kong, Japan, Middle East, they're not sort of, basically holding back and stopping in terms of just because they're looking at what's going on in the US. They're continuing to sort of do positive developments. We ourselves, for instance, announced a partnership on sort of stable coins with Standard Chartered and PCCW. So again, other areas are sort of progressing, but the main drivers we're seeing is still about user adoption and institutional inclusion, right? So institutions are now, because of ETFs, are saying, hey, we should take a look at that. And of course, Bitcoin is the first wave in which they get in, as they have done in the early days of retail, and now basically they're also starting to look at the rest of the ecosystem, broadly speaking, right? There's more financial products available for them. And on the consumer side, the opening up of essentially the Telegram user base into broadly the Web3 crypto space has introduced hundreds of millions of new users into the space that are now just beginning to form. I mean, this all just happened really in the last 3 to 4 months.
And so how does that informing the business decisions that you take? Because you've got a digital advisory business that's taking on a greater prominence in terms of the revenue that you're generating. So is that sort of where you see Animoca brands sort of trending?
Well, for Animoca brands, we continue to be very focused on investments. The digital advisory business is an important part, but actually investments continues to be, we have over 540 investments now at this point, continues to be a main driver for the business. The other area of big focus is the Mochaverse, right? And Mochaverse is basically our digital identity solution, where we basically want to build on-chain reputation, so we can basically identify, the good and the bad actors in the space in much the same way that the real world works. It's almost like you can think of it as a kind of, on-chain diploma in terms of your activities, so that you can basically be known whether you're a good actor or a bad actor, whether you're basically sort of playing the games, adding value to the networks, because it's all about basically growing out these network values. The other thing also I think we have to continue to do is educate the space as to what does it mean when you have a token, right? A lot of people get confused. Sometimes we still get the question of, isn't it like an abstraction of equity? And it's not at all, right? Owning a token is basically owning a part of the network effect, right? Whether it's Ethereum, Bitcoin, or a Mocha, or whatever token you're talking about, they're representations of these network effects. And that's a kind of new asset class that we haven't really seen before, and I think there's still unfamiliarity with that concept.
You are quite bullish, and that's, I'm not surprised. But I do ask, because we have seen or you have spoken about to other publications, but the value of Animoca brands trending lower in secondary market. would you see that being corrected by any sort of public listing?
Well, first of all, when you go public as a company, that actually creates the fair market. Right now, you have very thin trading. You don't have good price discovery. And secondary markets for various other companies are also trading below. I think that's not something that we're too worried about. We're not out there raising new capital, for instance. That's not something that's important for us. The base of our assets is actually, significantly higher than what you can be trading at. So in some ways, you could look at it as maybe a buying opportunity. It really depends on who you are. We've got interested people in the space. But the reality is that that's not our primary focus. Our primary focus is around building the business and really preparing ourselves for the eventuality of something like an IPO in the future.
And where would you be looking to list? Because Hong Kong has been a potential, but there's also the Middle East, which has been very friendly toward crypto institutions as well. So which one's more favorable for you right now?
Well, it's hard for us to sort of make a statement at this moment in time, but obviously we're based and headquartered in Hong Kong. I'm part of the Web3 Advisory Task Force. We've got a lot of activities, including the stablecoin activity in Hong Kong. We're actually very friendly with institutions and so forth in those areas. So, Hong Kong obviously is a strong contender, but, we wouldn't count out other markets. It's too early to tell. And as you well know, these things do take some time. So it's something that, will probably take, a couple more years to truly form out. And also we have to look at the markets, right? Basically. But I think to us, that's actually, if you look at companies like Coinbase, for instance, have been good representations of what happens to companies when they actually open up to a new segment. Again, we think that's another form of institutionalization of the crypto space.
So if right now in secondary markets, shares are trading at, say, more than a 50% discount, do you see that being corrected by an IPO, and when would you look to do it then?
Well, in terms of the dates, we can't confirm. In this case, I'm not really at liberty to say exactly which dates, but as you know, it can take time. But absolutely, the IPO markets are actually one that basically gives you the fair market sort of value for what the company is worth, right? We report our financials. We basically put out our sort of asset statements, both on and off balance sheet items. People can make their judgments based on that. But again, there is no real price discovery. And of course, unlike other companies, all of our shares are common, which means that you have the ability to trade them, privately if you want to, or in different exchanges. And what's happened is that our shares are available in I think a dozen or more OTC exchanges where they're basically just trading them. And again, it's not really under our control. And again, I think a public listing will certainly solve that. And of course, it's sort of building more institutional interest in the whole industry.
All right, well, certainly a listing of Animoca brands in Hong Kong would be a bit of a coup then for the city and its plans to push forward with the Web3 space. But that was the Animoca brands co-founder and chairman, Yat Su there. Shery, back to you as we, of course, kick off Token 2049 for another year in Singapore.
Yeah, very animated on your side of the world right now. Annabelle Jewelers there joining us from Singapore. We'll be continuing our live coverage at Token 2049. Stay tuned for our conversations with crypto-focused investment firm Dragonfly and blockchain research and engineering company Input Output. We are expecting breaking news out of Japan right now because we will be getting those trade figures. And when it comes to exports, we're seeing gains of 5.6% year-on-year for the month of August. This is really half of what economists had expected, almost. Imports also just gaining 2.3% for the month of August. This is leaving a trade deficit of 695 billion yen. We had turned into a surplus in the previous month of July, but right now for August, exports rising only 5.6%. We have seen now exports to China rise 5%, but to the U.S. falling and to the EU also contracting. Perhaps not surprising because in August we had the Japanese yen strengthening a little bit from those record lows in July. We're also following core machine orders. Month on month is a contraction of 0.1%. We've gone back into contraction territory. We had it just expanded for the month of June, but in July we're back in contraction territory, down 0.1% month on month for the month of July. Year on year, though, it's still growth of 8.7%. This is Bloomberg.
Shery, one of the things we look at every year is some of the movements when it comes to global business school rankings, right? We're now seeing not too much movement when it comes to right at the top. We're seeing Stanford topping the Businessweek B school ranking for a 6th straight year in this ranking. This is a sort of, a sense that some things at least stay the same, right, in an ever-changing world. For the 2024-2025 edition, Stanford University once again holding down the top spot out of full-time MBA programs in US schools, as it has over the past 5 years. It's maintaining strong scores in 4 out of the 5 areas that Businessweek indexes. That's compensation, learning, networking, and entrepreneurship. If you look beyond the #1 spot, the basic kind of nature and shape of the top end of the list has held pretty steady, with just a few exceptions. But we are seeing some of the other changes playing out in other ways. But we're seeing Stanford, Chicago Booth, Northwestern, Kellogg, Dartmouth, and Virginia coming in and rounding out the top 5. In terms of applications, though, interestingly, we're seeing some of the growth areas that we just had, including applications from domestically in the US and Canada.
And also, we have seen those Asian schools also rank pretty high. We're talking about HK UST in Hong Kong, ranking highest among Asian business schools. We also have Shanghai University of Finance and Economics coming in with a score 75.1. But the big question about business schools has always been, is it worth the investment? Well, we can tell you go to that side. You also have on the Bloomberg terminal as well. You basically try to figure out if you are going to get the ROI. So this is a calculator that really sets the profit relative to the initial investment, right? So you will get your return on investment, basically. So, for example, for Stanford, you can put in, for example, how much basically is the median cost to attend, and then how much you need to borrow student debt that you need to take. What would the rate of interest be right now, right? And then you can get something out of median survey responses for Stanford saying that they're netting about $1,023,898 over 10 years. So the ROI would be around 11.7%. So if you're thinking of perhaps, do you need to get an MBA? Go to that site. Coming up in the next hour, we're back live at the Milken Asia Summit in Singapore, where Bridgewater's Ray Dalio joins us to talk about his outlook for global economic growth as the world braces for a Fed rate cut. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens. Also counting down, of course, to the Fed starting its easing cycle. Haidi, the debate right now still 25 or 50 basis point cut. And it's not surprising. The policymakers, investors, everybody seems a little bit confused. We had U.S. retail sales also surprising to the upside.
Yeah, we're even sort of polling people in the office at the moment. I have to say, I'm not really willing to back 25 or 50, like John Authers said earlier. We wouldn't be putting a significant amount of money behind either at the moment. But it's interesting, Shery, we're seeing the yen taking a little bit of a breather because obviously some pretty major implications on where we go with this yen rally.
Yeah, so we had the Treasury rally really taking a breather, pausing, so that sent yields a little bit higher. We had the U.S. dollar slightly higher, especially from those January lows, and that sent the Japanese yen down in the overnight session, leading the losses among G10 currencies. Right now, we are seeing, again, a little bit of that resumption of the strength that we've seen in the past week. We have actually seen the Japanese yen perform pretty well this quarter. We're talking about one of the best performing currencies this quarter already. So perhaps not surprising that we got those export numbers for the month of August. Remember, in July, exports jumped more than 10% in Japan. Well, for the month of August, we actually saw it jumping by only around 5%, which is really also about half the level of gains that economists had expected. We're seeing Nikkei stocks now gaining 0.9%. We had really Japanese stocks under pressure for the last 2 sessions, so we're seeing a little bit of recovery there. We're still watching JGB yields, of course. It's all going to be about sovereign bond movements, given that we're also headed towards a BOJ rate decision on Friday. Not much expected this week.
Yeah, and as you mentioned, it really is seeing how sovereigns react to this Fed expectation, the delivery of whether it's 25 or 50 basis points, right? We are seeing that sort of softness when it comes to Australia's bond market as well. Investors very much in a wait-and-see mode. This is a picture when it comes to the start of cash trading, though. We're just about a minute and a half into the staggered session, unchanged. Quite a bit of sort of caution, but also, of course, we did see yet another all-time high when it comes to the ASX 200. In the previous session, we've had 2 days now resetting those all-time highs, and a lot of that being driven by financials as well as property-related real estate shares as well. The Aussie dollar is holding pretty steady, 67.60. Of course, watching to see if we get that sort of further recovery from the US dollar. That did see a bit of a bounce after the retail sales numbers came in a little bit stronger than expected for August. Whether that sort of changes the picture for the Fed going forward is the question now as well. Let's bring in Garfield Reynolds, who leads our markets live coverage in Asia. And Garf, is there anything specific that you're watching this week at this point?
No, like everybody, I'm waiting to find out what is going to happen with the Fed. Yeah, it's a very interesting setup in that, in a lot of ways, rates markets have actually decided they know what the Fed is going to do. They just don't know exactly when it is going to do it. You know, if you look sort of further out the curve, they've been pretty solid about pricing in 150 basis points of easing through the next 4 meetings. That's September, November, December, January. So what they're saying is the Fed is going to cut by 50 basis points at least twice over the next 4 meetings, and then cut 25 basis points those two. That's the most likely scenario. So in that particular situation, it's not surprising that the bets on a 50 basis point cut have proved so resilient, because if the Fed is facing a situation where it needs to make deeper cuts at some stage, the logic of the way monetary policy works, the whole context should be they would go 50. You know, no question at all. If you think you're going to have to go 50, go now rather than wait. That would be the marching orders. So that's kind of what markets are assuming, which actually means the biggest risk might not be what the Fed actually does today, whether it's 25 or 50, but what the dot plots show, how shallow those are relative to those expectations. Because you could get a situation where the Fed says, okay, we're going to cut 50 basis points, but then we're going to say we're going to cut 25 a meeting, or maybe even 25 a meeting at most. So we're going to have a dot plot that shows a fairly shallow move from here. If that was the situation, that might actually cause markets more disruption than a 25 basis point one, where they'd just be able to go, well, the Fed's out of its mind if it thinks it can get away with just cutting by 25 basis points. It's going to have to cut by a lot, never mind the dot plot, so we're going to stick to our knitting.
What could really lead to more disruption coming from the Japanese yen or the unwind of yen carry trades at this point?
Well, I mean, yeah, there's two risks there. You know, one is that if the Fed does deliver a 50 basis point cut and a fairly, if it sort of meets those expectations that are there in the swaps curve, then you could see the yen, power ahead. We saw a pullback in the yen yesterday. That was to some extent an acknowledgement that the data continues to remain resilient for the US economy. Treasury yields ticked up, so the dollar came back against the yen. Now, it might also mostly been about position squaring, because this is a big event risk. You don't want to get too over your skis, but it does underscore the potential that a more dovish than what you might call the whisper number Fed, that would send the yen through that 140 level. There's also the potential that even if the Fed doesn't send it through there, the BOJ does, because although the BOJ is fully expected to leave rates where they are at this meeting, again, the risk is in the outlook. And if you remember last time around, the initial decision from the BOJ, which was to hike rates, didn't set off huge yen gains. The yen gains really kicked off once Ueda came out and made it clear they were willing to go on hiking rates, provided just that the Japanese economy met expectations, not exceeded, but met expectations. So he put us all on a pretty solid track towards BOJ rate hikes. If that track remains solid, if it remains the case that the BOJ is likely to exceed what the market is pricing for moves in the coming months, that could send the yen down through 140, and that's going to cause a lot of pain for, I mean, it's not just the straight carry trades, it's the general setup. There are a lot of investors, both Japanese and otherwise, who are essentially structurally short yen, and if they do have to unwind those shorts on the yen, if they have to buy the yen, that is going to cause a lot of pain across a wide range of assets, not just the occasional hedge fund that got caught out by a momentum trade.
The pager attack in Lebanon is sort of, perhaps a pertinent reminder that even as markets remain pretty sanguine about geopolitical risk, it's always there in the background.
Yeah, oh, very much so. That's something that's on our radar. Keeping an eye on where Brent goes today is definitely a good idea. It's an interesting one in that the overall outlook for crude oil is not good. The demand side and the supply side as well, because the US and other non-OPEC producers keep on boosting output. So oil, it is not about to go sustainably back significantly higher from here, probably, even if there is, well, maybe unless there is a really big conflagration in the Middle East, something that it looks like there's not a lot of appetite for, but it's going to remain, a warning sign. It's going to remain the sort of thing that is going to drive people towards the Swiss franc, also potentially towards the yen. It's going to act as a cloud for treasuries because on the one hand, they're a haven asset. On the other hand, higher oil prices, even a short-term leap in oil prices, it has tended to hurt them because of inflation concerns. It's also going to be very interesting from the point of view of the impact on gold. Might muddy the picture a bit too, because for gold, that's one of the things we're really looking at going into and out of the Fed meeting. There's this concern that the importance with the Fed meeting is what's the messaging and whether they can convince people that a soft landing remains on track. If you get gold jumping up, say, past $2,600 per ounce, that's your sign that the markets are pricing for a recession.
Garfield Reynolds, who leads the market's live coverage in Asia, there with his take on all of the market moves we should be expecting this week. But take a look at some of the early movers, especially in the Japanese session. Nippon Steel is the one that we're watching because Bloomberg has learned that the company will receive an extension in the security review over its $14 billion deal for U.S. Steel. Now, of course, this has been a political flashpoint in the U.S. election, right? And the move technically allows the company to revoke and refile its submission to a security review panel, and this would restart the clock and potentially push it to after the U.S. election. Right now, we're seeing the share gain by the most in more than a week. We're also watching some defense stocks as well across Asia. North Korea fired at least 2 suspected ballistic missiles in what would be their second barrage this month. The projectiles were launched early Wednesday and have likely already fallen outside of Japan's exclusive economic zone, according to Japan's Coast Guard. And also this comes after North Korea this week sent its foreign minister to Russia. Let's get back to the Token 2049 crypto conference in Singapore. Our tech reporter Annabelle Jewelers is still there. Belle.
Thanks, Shery. Well, I hope you can take that sound as a symbol rather of the energy and enthusiasm at the event today. But Token 2049 is a global cryptocurrency conference bringing together some of the biggest names, the biggest businesses in this region or in this industry. And later this hour, we'll be speaking about the venture capital industry with Dragonfly, a pretty well-known name in the space, talking about that gradual recovery we're seeing. Is that genuine evolution, or is it being driven by FOMO instead? So an interview to watch out for this hour, and later ahead as well, speaking with the founder of Cardano, one of the big tokens in crypto. But that's it for Token 2049, kicking off for another year.
Annabelle Jewelers there in Singapore. Coming up next, we'll also be live also in Singapore for the Milk and Asia Summit. A conversation ahead with Dalio for his views on the US presidential race and the state of the US economy ahead of a likely Fed rate cut. This is Bloomberg.
I'm Haslinda. I'm in Singapore, where the 11th annual Milk in Asia Summit is underway. We want to welcome Bloomberg television viewers, as well as radio listeners all over the world. Well, joining us now is Ray Dalio, founder and CIO mentor at Bridgewater Associates. Ray, good to have you with us.
Good to be here.
Global leaders, they're grappling with a host of issues, but you say there are 5 key factors, forces that are perhaps defining and shaping the global economy. Before we get there, though, today a big day for the markets, the Fed front and center, 25 of 50. That is a key question. And I know you said before that you're right 65% of the time when it comes to markets. So what's the bet on?
I think it's such a silly bet, like 25 or 50, it doesn't make a difference. I think that's the problem with the news cycle and all of this. They're losing sense of the bigger picture. Okay, Fed policy. What does the Fed have to do? Fed has to keep interest rates high enough to satisfy the creditors, that they're going to get a real return without having them so high that the debtors have a problem. So now if we're looking at this, whether it's 25 or 50 basis points, 25 basis points is going to be would be the right thing to do if you look at the whole picture as a whole. If you look at the mortgage situation, which is worse, and that affects more people, then it's probably 50 basis points. But let's get beyond that, okay, and talk about these 5 big forces. The first of those forces is the force that you're referring to, which is excuse me, the debt, money, economy, dynamic, and force. Okay, so we have a big debt increase, we have an enormous amount of debt, and it's going to keep increasing, and one man's debts are another man's liabilities. Okay, so what is that going to mean for monetary policy? Okay, as you have to sell more and more of those bonds, what will be done? I think the same thing was done in Japan. Though that what happens is there's not going to be a default. Of course there won't be a default. But increasingly they have to drive down real interest rates so that real interest rates are significantly negative. So you're going to have, in order to service the debt, you have to have a significantly negative real rate, and you also have to have then the depreciation of the value of money because inflation rises, so that you have to have a nominal growth rate, in other words, inflation plus real growth, that is above the nominal interest rate, and you have to have a real interest rate that is negative, and you have to have a positive slope yield curve so that holding bonds is a bad deal.
What is the state of the U.S. economy? I mean, we're talking about 25 or 50 based on the assumptions of how the economy is doing. Okay. From the data that we've gotten so far, does it justify 50? I mean, what does it say?
We have a model for estimating what should be. The economy right now is very, very, very close to an equilibrium level in many ways if you're just looking at what is and you're not looking at the debt problem. And it would look like there should be a modest easing of interest rates and a move gradually to a more positively sloped yield curve, what we would call normal. It's fairly normal, except it's not normal in the way that it's so skewed. So if we look at the markets and we look at the way the population's income levels are for the various sectors, if you look at the bottom 60%, if you look at the politics, the left and the right, and the nature of what is going on, the two worlds that we live in terms of that, the economy and the values, that brings us to the election. So if we are talking about, let's say, monetary policy, you have to look at the 5 forces. So back to the 5 forces. The first force we talked about. The second force is the force of internal order and disorder that progresses in a cycle. There is hard left and hard right. So there's ideological differences that are creating a political situation that leads us to not only have possibly different policies, dramatically different policies, which will have an effect on the economy and have an effect on the markets, but even worse or more concerning is that it's conceivable that one side or another might not accept losing. Okay, so how will we have an orderly transition of power, and will we have an orderly democracy in which there's the ability to have disagreement and the resolve of those disagreements? I think that these are really questionable situations. So the second force is that internal order disorder force. The third force is the great power conflict. In other words, throughout history, there's a time when the rising power challenges the existing power, and there's a world order thing going on. And that world order thing going on has to do with China, the United States, and so on. And of course, it becomes even more important than the economy because it's considered national security, okay? The fourth influence is, all through time, is acts of nature, droughts, floods, and pandemics. And climate is a big influence. It's going to cost us $8 trillion a year, it's estimated, in one way or another, in a world economy that has 100 trillion. And the fifth force, of course, is technology, okay, man's inventiveness of technology. Throughout history, those five forces have interacted. So when we look at things, I think that there's the 25 or 50 basis points. Let's get beyond that. Let's look at the whole arc of that in terms of the changing of all of those five forces and their interrelationship.
Let's get back to internal conflict and link it to the U.S. elections.
Yeah.
How do you see it playing out? How do you see the next few months, 50 days to elections? How do you see that playing out?
Well, as I say, I think that there's two questions. First, the question of will we have an orderly transition of power? That's quite amazing. Will we have democracy work as it is? That cannot be assured, right? So because behind all of this is that we have irreconcilable differences, not just pertaining to taxes and wealth and economic policies and so on, but in terms of values. You know, it's how do people raise children related to sexuality and all of those things. There are those gaps. So I think we hope for an orderly transition of power. Isn't it quite amazing that we would think, could we not have that? And then we go beyond that, and then we say, what about those policies that are going to be dealt with? Nobody's going to deal with the debt policy. That's going to end up being monetized down the path. Then the question is issues of taxation, and those issues of taxation will have an important impact on the capital markets. If they're bought for after-tax returns, by and large, it's the important thing. You lower corporate income taxes, you raise corporate income taxes, it makes a difference to prices. So we're going to have those issues, a lot of issues to talk about regarding the election. I think when we go beyond that, most likely, there is going to be irreconcilable differences, and I think that you're going to see more movement to states. So there'll be a challenge of what does the central government control, and what do the state governments control, and is there an obedience in a sense. So we are coming more to a fragmented set of circumstances. What we would need, I think, is strong leadership of the middle to bring the country together and isolate more of the extremists, if that was possible, and then to make reforms, because we do have a very skewed type of economy.
So is that Kamala Harris?
But there's no, I don't think it's either of the candidates. Okay, I don't think it's no, it's not either of the candidates. I think that the issue of reform, strong leadership in the middle, I don't see it.
We've been talking about a changing global order. China comes to mind automatically. The conversation right now is a massive slowdown in China, economic malaise. But people seem to be missing the point that amidst all the slowdown, China is still innovating. Renewables, EVs. How are you assessing?
I think that there are real issues in China now, and they changed really in the last 4 years. And that is that they need a restructuring. A lot of the spending, well, let's say, individuals, 70% of their money was in real estate. Real estate has gone down. Stocks have gone down. Salaries have gone down. And so, and as a result, they're not spending and they're concerned and they're holding money in cash. With deflation, cash is a relatively good asset class. That's kind of the household and the business sector is in that state. At the same time, you have the government sector is a problem because most of the government spending, 83% of government spending, is spent by local governments. Those local governments got their money by selling land for real estate. Okay, there are no land sales, and they borrowed a lot of money, and those that they borrowed the money don't get paid. And so the question is, how are you going to get money into those places to operate? It's a situation that's more challenging than Japan in 1990. It needs a restructuring in order to be able to do that. And then there's also the question is the property values, the property ownership. Is it respected? And Deng Xiaoping during his period said it's glorious to be rich. Is it still glorious to be rich? So you have an environment in China which is changing and becoming a more difficult environment. So it's the time right now that you would see either is there going to be a restructuring and a getting past that. The innovation, yes, there's fantastic innovation. In terms of technology, there's nothing like it other than in the United States. Europe certainly isn't a competitor in that. However, it's very much government directed. Can there still be entrepreneurship and that inventiveness? These are big cosmic questions for...
Given the environment that you have just painted for us, is China still the place to do business? Is China still the destination for your investment money? You've said time and again that you should be invested in
yes,
China.
I just want to be clear about the investing in China. In all countries, there are cycles and ups and downs and so on. And in no country should you invest so much money that it becomes a dominant portion of your portfolio. So in China, I still invest in China. The question is the size of the investment and how that investment is structured. So it's been a good experience for us investing.
What's the size and how are you invested? Because your report suggesting that Bridgewater, for instance, has been cutting down its exposure to China, its holdings to China for the last 7 years.
It's not my place to talk about Bridgewater's
exposure. That's fine, but how do you see investing in China?
I see investing in China as largely a very attractively priced place that now has a lot of questions regarding the issues that I've just referred to. In other words, the economic issues and the political issues regarding property rights and whether it's still glorious to be rich and how that'll work. Therefore, there's a small percentage of our portfolio which is in China and will stay in China, through this process.
One of the big forces shaping the world today is technology, AI, Gen AI. You're big on it. You're looking at a bot so that people can have access and have conversations with you. I mean, what do you see the potential? And of course, if it's technology goes wrong, your bot could go rogue. I mean, how are you assessing, the risks as well as the rewards, the benefits of AI and Gen AI?
Well, for the last 35 years, I've written down principles and decision rules, literally many thousands of those, and they have operated as systems, decision-making systems. And that now I'm very excited about that because but you have to train them very well. Because it's been also specified over a period of time, it is very educational. I've then taken a large team of people and gone through asking it questions and dealing with it and training it. And the reason is a lot of people ask me questions. I'm at a phase in my life where my main objective is to pass along what I've had that it's a benefit to others, and we interact, such as this kind of conversation. And I thought it would be great if I could answer all those questions, or we could have discussions. How are you doing and all that? So that's what I've created. It's called Digital Ray, at least that's the tentative name, and we're beta testing it. We're going to have several thousand people test it and see how that goes, and then we'll move forward. But I think it's exciting when you need to have computerized decision-making working with you, because the time of making all those decisions in your head, that's obsolete. The smart person who thinks, I can weigh everything in my head, they're obsolete. nowadays you have to have a partner in terms of those decision-making with the computer.
Ray, final 30 seconds. We also know that Gen AI sucks up energy. They say as much as a small country. Surely that is a concern.
Oh, of course, it's an important concern. The real question is its productivity. I think a lot of attention, a lot of the finances have been in the development with the superscalers. I think the real opportunities are going to come in terms of the users and how that's going to change productivity. In fact, probably invent ways that technology wouldn't be so much of
Ray, we have to leave it there. Great
Okay.
conversation.
Thank
Ray
you.
Dalio, founder and CIO mentor at Bridgewater Associates. We're coming to you live from the Milk in Asia Summit. Keep it here with us. This is Bloomberg.
We're about an hour away from the Chinese markets reopening after a long weekend, and investors really facing a series of disappointing data out of China, and of course the possibility that we could see more downside in Chinese equity markets. We're talking after the CSI 300 already closed on Friday at a 5-year low. But take a look at the setup right now, and trading across Asia, a little bit mixed, but when it comes to Japanese equity markets, we're seeing energy, consumer discretionary, and financials leading the gains. We have real estate and utilities weighing on the index. The Kospi right now is away on holidays, but we closed with an upside of 0.1%, and New Zealand Kiwi stocks are now losing a little bit of ground. But of course, we're really watching what will happen with the Federal Reserve. Is it a 25 basis point rate cut? Is it a 50 basis point rate cut? The market implied odds right now of a potential outsized 50 basis point reduction are higher, a probability of more than 50% at this point. And of course, Heidi, what happens with the Fed has such big implications for Asian central banks, right? I mean, we do have other rate decisions across Asia this week as well. Of course, let's not forget about the Bank of Japan that we've been talking about the entire week, the entire month, the entire quarter. But we also have Indonesia, China, Taiwan also holding decisions. And the likes of South Korea that we've been watching very closely, the likes of the Philippines that's struggling with inflation, is really not just gaining more leeway from a rate cut in the U.S. is also what will they do when all of these Asian economies face idiosyncratic risks.
Yeah, the currency of risks is really front and center, isn't it? You spoke about, why we've been talking about the Bank of Japan and those expectations there at such length. And we see a little bit of a pause when it comes to the yen rally, and, a lot of, I guess, sort of applause when it comes to how policymakers have handled being able to stem the yen weakness and turning that story around, along with the views on the rate divergence going forward. But of course, there's a sense of precariousness as to whether that could all be upended if we get another bout of currency volatility. The other side of the coin is really places like Australia, where the RBA is really still pretty behind the curve. They were slow to kind of get started, and they are really slow to kind of get into the easing part of the cycle, with the economic pressures still mounting, but with the inflation picture still quite unclear. Meanwhile, you have, of course, the RBNZ that it's already, it had started, it was one of the first to cut, and now it's one of the first to ease as well. They're seen to be likely to cut through the rest of 2024. That economy has been teetering on the edge of a third recession in 2 years. Very, very different picture if you look across the rest of the region, right? Inflation is still a big problem in India, the Philippines. Caution is likely to be the name of the game there for policymakers, Shery.
Yeah, not just inflation, as we mentioned, right? Because as I was saying, the Bank of Korea, for example, facing really surging property costs, not to mention that, of course, there are financial risks related to rising household debt across the economy. And perhaps even the Bank of Thailand could be one of the longest holdouts when it comes to moving expectations that, the Bank of Thailand will resist those government calls to cut until at least next year.
Shery, a lot of this has to do with what we see when it comes to the outlook and the pricing and market dynamics for broader commodities, right? Whether energy continues to be this sort of flashpoint when it comes to inflation expectations around the world. Take a look at how we're performing, and of course, it really has been geopolitics, Middle East tensions firmly back in focus in the session. We're seeing oil steadying after that two-day gain. Traders really assessing these rising tensions in that part of the world after the pager attack in Lebanon. Also balancing indications of higher US stockpiles, more supply coming from markets like the US and in Europe as well. But again, still that weakness in demand out of China. Overlaying all of this, of course, is the uncertainty over the Fed's likely course when it comes to the rate path there. We saw a rise of almost 3% for Brent over the previous 2 days there. As we continue to monitor those developments in Lebanon, Hezbollah accusing Israel of orchestrating that attack involving pagers in Lebanon. A number of people dead, wounding thousands there as well. And of course, again, supporting those prices on the fear of further and widening conflict in the region. We're also seeing, interestingly, a little bit of upside when it comes to iron ore, which has been under pressure lately on account of that China weakness. About 0.5% higher that we're trading when it comes to Singapore at the moment. And also watching copper, of course, usually a pretty good a gauge of growth expectations. Very flat at the moment, really, along with aluminium, just treading water ahead of the Fed decision. Shery.
And Heidi, take a look at one commodities-related stock that we're watching here in Japan. Nippon Steel accelerating gains in the Tokyo session, at one point surpassing more than 2% gains for today. And this, of course, would mark it as the best day in over a week. We got news that Nippon Steel will receive an extension in the security review over its $14 billion deal for U.S. Steel. This is according to sources speaking to Bloomberg. Our breaking news editor, Gareth Allen, joins us now for more on this. And Gareth, this could actually take the deal past the U.S. presidential election.
Yeah, that's exactly right. So it seems, according to sources, that Nippon Steel's deal to take over U.S. Steel will be allowed to be withdrawn and refiled, which gives them another 90 days, which will take it beyond the election, and in some senses will remove some of the political difficulties associated with the deal in the short term.
I mean, it's been surprising how contentious this has become in the U.S. presidential election, perhaps a lot to do with the fact that there are lots of workers in Pennsylvania. That's
exactly right. And it's a key state in terms of the U.S. election. All of the contenders, I mean, Biden said no, Kamala said no, Trump is saying no. So, you know, it really is, the U.S. position on it is they want the company to remain a U.S. company. But that's not necessarily a good thing for the company, because, of course, the company itself has said that, you know, it's going to have to close plants, it's going to have to lay off workers if it doesn't go ahead. So, you know, the reality is that it's probably a good deal for US Steel itself and for America, but you know, the political issues has really become the main issue in terms of this deal.
So, you know, the likelihood is that the CFIUS review will continue to run into issues, right? Are there any options left, given, as you say, this is, you know, a company that has seen years of sluggish performance and will be facing a great deal more operational difficulties?
Yeah, that's exactly right. So, I mean, it seems that it's not going to be positive for the company if the deal doesn't go ahead, and it's not politically viable for the deal to go ahead. So, you know, at the moment, you know, it seems today, according to the sources, that there is a slight reprieve, that the can has been kicked down the road for the moment. So we'll certainly continue to watch this as it develops going forward.
Our breaking news editor Gareth Allen there with the latest on US Steel. More ahead on the Edge of Trade. This is Bloomberg. Let's get more now from the Token 2049 conference getting started in Singapore today. Annabelle is there with our next guest. Belle.
Thanks, Heidi. Yeah, as you said, Token 2049 kicking off for another year in Singapore. Lots of attendees expected today, but one of those, of course, is Rob Hadick. You are the Dragonfly general partner, and Dragonfly, of course, a well-known venture capital firm in the space for crypto. talk to us about what's happening in the industry, because we have seen quite volatile the VC space. We had such a big run-up in terms of funds that were being raised, deployed, slumped. A bit of a recovery perhaps coming through now. What are you seeing exactly?
Yeah, so thanks for having me on first. But I think the market today is a lot healthier than it was, as you talked about, like last year and the year before. We've had a number of tough years around kind of the fall from FTX. We've had a number of tough years around just the macroeconomic cycle more broadly and how that's affecting crypto. But now what we're starting to see is a lot of excitement around things like tokenization, a lot of excitement around things like bringing institutional partners on chain for stablecoins, cross-border payments. And that excitement has been kind of permeated a lot more globally. So we've seen this uptick in venture capital funding this year that I think was going to serve us really well going into next year, and I'm really excited about that.
Do you think then those things that you're just mentioning there around tokenization, for instance, those tie-ups with institutional investors as well in the space, is that a signal to you then that this is sort of being more driven by mainstream breakthroughs, or do you think we've really seen that just yet?
I think we have a long way to go, absolutely, but there's no doubt that it's happening now, right? So BlackRock is, they tokenized their fund BUIDL on Ethereum mainnet. That is probably the first of many things that they are going to do. We see, PayPal launching their own stablecoin. We see cross-border payments happening across a number of different large banks and globally. And so it's clear to me that this is continuing to happen, but a long way to go still.
What kind of areas then are you most interested in from an investment perspective? Where are you looking to deploy the cash right now?
Yeah, so we are still focused on the infrastructure side. There's been, I think, a lot of complaints around too much capital in the space has gone to infra. But, things like Monad, which is a portfolio company of ours that has really had the first kind of update or EVM since Ethereum. That's been really exciting for us. But also the application layer. So things like Polymarket, which is, we did their Series B earlier this year. We've seen them really kind of come into the mainstream and bring and be able to aggregate kind of collective intelligence in a way that we haven't seen before. And so that kind of application layer is also really excited for us right now.
And if you're concerned about perhaps too much cash being available in the infrastructure space, what sort of valuations are you looking at as well?
Yeah, so valuations have definitely been a little bit crazy. Not this year, but all the way back to 21 and 22. I think at the later stages, so B, C, we've seen pretty attractive valuations, and we've been able to get into deals and different types of investments that have been exciting there. I think in the earlier stage, it has been honestly quite high valuations still, but we're excited about kind of some of the new innovations, things like DePIN, stablecoins, some of the AI crypto crossover stuff has been exciting. So we're still playing there, but we're being thoughtful around what valuations look like.
Can you just give us a sense of how much you think the frothiness is there? How much are things being overvalued at this point in time, do you think, possibly?
Yeah, so I think it's absolutely true. I don't know if there's an exact number, but what I would say is, in the traditional Web 2 world, a Series A kind of valuation would typically be, call it $40 or $50 million post. In crypto, because of the liquidity of tokens, what you often see is, these things are getting done at, call it double that, right, or triple that. Now, at times, valuations in crypto in the public token market as well have been disconnected, and so you're able to and willing to pay for that. But it's unclear to me that that's going to continue, and so at least for us, I tell all of these companies I talk to, we're never the cheapest capital.
Mm-hmm. Can you give us share more details on that? Why are you not the cheapest capital?
My belief is that over time, the venture markets that have existed in Web 2 and the venture markets that exist in Web 3, while they've looked very different today, they will eventually look a lot more alike in the future. And so valuations will normalize a little bit more. We will have a little bit more fundamentals. As we see more institutions come into the space, which we've seen really this year for the first time since 21, the market gets more efficient. And because of that, us as long-term investors have to be thoughtful around how we really, kind of bridge that gap between the two and what we think we can, pay to get the returns for our clients.
How's your fundraising going? Because Bloomberg has been reporting that you guys are looking to close a $500 million fourth fund.
Yeah, so we're not allowed to talk about any potential fundraising. Securities laws don't allow us to do that. We're a registered RIA, but we're still really focused and excited about, our portfolio, helping our, current entrepreneurs continue to be successful, and excited about serving our clients.
What would be then the fundraising environment generally? What are you seeing? What's the appetite to give money to names like Dragonfly?
So, more broadly, I think we've seen a lot of funds out in the market. It has been a lot more diminished in terms of interest relative to 21 and 22, but frankly, the market was too eager then. There was too much capital for us to digest. And so what we've seen this year is a lot of those large LPs, institutional LPs, want to really consolidate their interests and select maybe the biggest winners. And but there is still a lot of interest. They understand crypto. They want to be here. They just want to be more thoughtful about how much of their portfolio goes into it and who they're backing.
You're based in the US, and of course they've got the election coming up later this year. Trump is seen as someone who's a bit more pro-crypto, but what do you see as the sort of outcome with either Trump or Harris for crypto, and what does that mean for prices from here, do you think?
Yeah, so politically, the market is, I think, expecting it to get better regardless. So what we've seen under the Biden administration has been really at times anti-innovation, unfortunately, and it's pushed a lot of that innovation, a lot of the entrepreneurs out of the U.S. and into other parts of the world. We've seen the Harris administration at least talk about being more friendly to the industry and wanting to foster that innovation. And so I think we expect that will happen regardless. But, the Trump administration has embraced crypto, also much more fulsomely. And so I'm excited about, no matter who wins, hopefully a better interaction and more, working with the industry coming out of, whatever that administration is. But regardless, there's too many, endogenous reasons that crypto is just, continuing to innovate, continuing to permeate into places like, Sony building their own L2 with Sonium and BlackRock, as I talked about earlier, to not be, at least for me, really bullish about prices next year.
All right, Rob, that was Rob Hadick there, Dragonfly General Partner, Shery, as we get Token 2049 underway in Singapore, the biggest cryptocurrency event in Asia.
Thank you, Belle. And of course, Belle will continue these conversations at Token 2049. And if you missed any part of her conversations today, go to TV Go. You can watch our past interviews and also watch us live. You can dive into any of the securities or Bloomberg functions that we talk about and become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg. Tech billionaire and philanthropist Bill Gates says world leaders must step up the fight against a worsening child nutrition crisis that's causing trillions of dollars in economic losses. He also told us how he sees AI playing a role in boosting health.
Malnutrition in some ways is such a basic thing, so we do need to raise money to get resources for this so that the poor countries get out of the poverty trap and then are self-sufficient. The innovation is going to accelerate. Tools like AI are helping us understand the gut, the immune system, how to design vaccines in a very deep way. And the key thing that the foundation has with innovation is making sure it's not just helping the rich countries, but it's helping the poorest. And so, can they get medical advice in their native language on their cell phone? Can they have the diseases that are so ignored, like malaria? Can we use AI to develop ways to not only reduce that, but eventually eradicate it? And so, that's where the foundation is, looking at the innovation and making sure that it's benefiting those most in need.
The foundation talking with global leaders often, I'm sure, global leaders of wealthy developed nations who are preoccupied right now with their own political instabilities, their own worries about the cost of living. Will you get the help you need from developed nations, do you think?
No, that's a very good question. The dream is that even in the face of huge budgetary challenges that all countries have, that they would be willing to have 1% to 2% that go to help the poorest, to help these countries move forward. And these are things where you're saving a life for less than $1,000 per life saved. So, very catalytic, very well measured. I wouldn't be putting my money in unless I knew that it was extremely well spent. And so we're trying to keep this on the agenda to continue that miracle that took place, where we made so much progress getting rid of childhood death.
You talk of that miracle, and I've got to ask you, as someone who, almost sees us taking those steps ahead, and then it feels as though something gets in the way, call it a war, call it a global epidemic, and we take what feels like 2 steps back. Do you ever just lose confidence? Do you ever feel that this is a fight that can't be won?
Well, I will say that when we set the current goals, the United Nations, which are called the Sustainable Development Goals, we didn't anticipate a pandemic. We didn't anticipate the financial difficulties that the African countries would find themselves in, paying more in interest than they can for health and education. And we didn't anticipate the wars that have broken out, both Ukraine and several others, including the Middle East. And so the goals we set for 2030, you look back and, it feels a bit naive, but, every life saved really counts. Here we're talking about millions of lives. We're talking about making these countries stable, having health systems so that if a potential pandemic's getting started, they can stop it before it spreads globally. So not only the moral benefits, but the global benefits are pretty strong. And yes, it's harder today than it was a few years ago to get through the noise level, to get this cause to be heard. But, because it's, it's about helping other humans, I think we'll succeed.
Bill Gates speaking with Bloomberg's Caroline Hyde as we brace ourselves, Heidi, for the reopen of markets across mainland China, Hong Kong, away on holidays, but of course the mainland coming back from a long weekend. And remember, the CSI 300 on Friday finished at a 5-year low. The Shanghai Composite very close to a 5-year low as well. This as we're headed towards a Fed rate decision, and we still don't know, will it be a 25 basis point cut or a 50 basis point cut? And of course, the data coming out of China over the weekend really perhaps not supporting that. No encouraging signs when it comes to the market.
No, it's not like they're coming back to play catch up with some good news, right? It was all bad news. It was even further deterioration when it comes to those domestic activity indicators, whether you talk about retail sales or domestic investment or, industrial production, all of which is continuing to trend in the wrong direction. So it does look like without very decisive, very symbolic government intervention, more stimulus and more of the big bang type rather than prudent and incremental, we should expect to see Chinese equities continuing to face that downward pressure. That growing disparity between Chinese stocks and the broader Asian market also painting a pretty bleak picture when it comes to investors that still have exposure to China and investors that have exposure to EM. And it's pretty interesting. We're seeing that sort of growing decorrelation between Chinese risk assets and emerging markets. We'll be getting a lot more on this story as well as other views from the Milk in Asia Summit in Singapore. We'll be speaking to Capital Group's Vice Chair, discussing her global markets outlook and strategy, as well as the energy transition with Malaysia's Minister of Natural Resources. That is it for the Asia Trade. The China Show is next.